America appears to be speedrunning its own collapse, even though right now America is doing a million things from tariffs to getting more control over the Panama Canal to pardoning the founder of the Silk Road. And no, not the ancient Silk Road that revolutionized trade, but the modern online and dark web Silk Road that revolutionized trade for things like, hiring your local hitman. Regardless, one thing is true. There's a financial experiment that has been going on in the United States for years that is only getting worse and might speedrun the collapse of the American empire. And it's all tied to the oldest surviving theory of economics. A story that I've never told before on this channel, and one that clearly the modern world has not learned from. You see, the 16th century was Spain's golden age, both metaphorically and literally, because they had so much gold it physically broke their economy. You see, at this point, Spain had built an empire that stretched from Europe to the Americas to parts of Asia. They had looted the Aztec and Incan empires, drained the Peruvian silver mines, and set up a trade network so massive, entire fleets of ships were dedicated to hauling New World treasures back home. At first glance, it was a dream setup. Step 1, steal all the gold and silver. Step 2, infinite wealth and empire. Step 3, profit. But it turns out when you flood your entire economy with more money than it knows what to do with, bad things will eventually happen. You see, around this time when Spain was building its empire, a magical thought arose. And that was, wait, what if just printing, or in this case mining, more money doesn't actually make you more rich? Because instead of infinite prosperity, Spain got rampant inflation, economic stagnation, and an empire-wide financial crisis. And what happened was something called the price revolution, which happened over 150 years in Spain. And this was essentially an economic experiment that was, what happens when a country treats money like an infinite resource and doesn't consider its consequences? Not that essentially every country in the world isn't doing the exact same thing today. We're pretty screwed. Anyways, you see, Spain wasn't just importing gold and silver. It was importing too much gold and too much silver. The moment huge shipments of precious metals started pouring into Europe, the price of everything skyrocketed because suddenly money was everywhere. Yet, actual goods and labor remained about the same. Between 1500 and 1650, prices in Spain quadrupled. And let's remember that number, because prices only quadrupled over 150 years. Yet the prices in the United States have quadrupled just in the last 50 to 60 years on most consumer goods. I mean, a loaf of bread was just 51 cents in 1980, and today it's almost $2. So while the Spanish government and elites were stacking literal rooms of gold, the average Spanish citizen saw the price of basic goods slowly spiral out of control. Sound familiar? Well, because this is exactly what happens when the money supply expands too fast without corresponding economic growth, which is what the quantity theory of money is based on. Now, there's actually a formula for this, and it is MV equals PY, meaning money supply times velocity equals price level times real output. And this was an equation that Spain accidentally beta tested in real time. Their money supply exploded, but productivity didn't, so the economy just got more expensive without getting better. And here's where the real human nature stupidity kicks in. Instead of trying to fix this problem, Spain doubled down. You see, Spain decided that they were already a filthy rich country and they didn't actually need to produce anything themselves. They essentially became the 16th century version of a country that exports nothing but buys everything. Kind of like, wouldn't you say most of the modern westernized countries in the world? Buying all of their goods from Asia and making their entire economies based off of finance and real estate. But anyways, let's see how things played out for Spain. So they stopped making things. They imported the vast majority of their goods from places like the Netherlands, Italy, and all over their empire. Because why build stuff when you can just pay others to do it for you? They also overtaxed their economy, and they did this because the Spanish monarchy was desperate to fund its endless wars, so they just hiked taxes on everything and everyone. They used debt like a teenager with a brand new credit card that knew nothing about finance. Because yes, they were swimming in pools of silver and gold, yet they still needed to take out massive loans from Italian bankers to fund their government expenditures. By the late 1500s, Spain's economy was completely unsustainable. Inflation had wiped out the purchasing power of silver, taxes crushed the working population, and manufacturing had been outsourced to rivals. Meanwhile, the elites were laughing all the way to the bank. So, I want to ask you, what happens when a country refuses to acknowledge basic economic principles and keeps throwing money at the problem? Well, it goes bankrupt. By the 1600s, Spain was no longer a dominant economic power. Its economy was in shambles, its military was struggling, and its empire was shrinking. And this was unthinkable at the time of the peak of the empire. And a little bit later on, people like Jean Baudin and David Hume began theorizing about the relationship between money supply and inflation, laying the groundwork for what would eventually become the quantity theory of money, the oldest surviving theory of economics. Now, for most of the United States economic history, policymakers actually believed in the quantity theory of money, the simple idea that if you print money without growing the economy, inflation will follow, and/or things will get worse for the average middle-class person. So for example, from the 1870s to 1933, the money supply was strictly tied to gold reserves, preventing the government from just printing its way out of debt like a kid playing Monopoly. Even in 1913, when the Federal Reserve was created, which was a little bit of a controversy today and still at the time, the Fed was created to manage inflation and keep the money supply stable, acknowledging that excess money supply was, well, bad for the economy. From 1944 to 1971, the dollar was pegged to gold, again enforcing discipline. You couldn't just conjure dollars out of thin air without any real economic backing. Even after the inflation crisis of the 1970s, Milton Friedman and monetarists took charge. They argued that controlling money supply was the key to stable economic growth. They aggressively tightened money supply, causing a recession at the time, but ultimately saved the dollar from turning into a worldwide joke. However, around the 1990s, things started to change. The US government and the Federal Reserve looked at all this historical evidence, all these hard-won lessons about inflation and money supply, and collectively said, yeah, but what if we just ignore all that? The 1990s saw deregulation, globalization, and a belief that deficits no longer matter. The US increasingly borrowed money instead of relying on real growth, and by the early 2000s, Alan Greenspan's Federal Reserve started artificially lowering interest rates, making borrowing money and money creation much easier. And then all this came to a head in 2008, when quantitative easing was born. A fancy way of saying, let's pump trillions of dollars into the financial system and just kinda see what happens. The money supply exploded. However, inflation did not skyrocket, technically, because most of it got stuck in the banking system and financial assets, causing massive stock and real estate bubbles instead of consumer inflation. I mean, if you were to compare the stock market today to what it was in 2006 or 2010, you would see where all the inflation went. It mostly did not go into consumer goods, although some did. It went into all investing assets to keep the economy afloat. But because the inflation on the official government numbers didn't show up right away, people started believing the old rules of money didn't apply anymore. So if 2008 was when the US started printing money like crazy, then 2020 and 2021 was when the US government truly lost its mind. The money supply, or the M2, increased by over 40% in 2 years, which is the fastest expansion in modern history. And this money printing happened all the way up through 2022 before taking a brief break for about a year. But yet recently, it has been exploding once again. The government handed out trillions of dollars in stimulus checks, business bailouts, and unemployment boosts, while the Federal Reserve kept interest rates at 0% and continued buying assets to pump liquidity into the financial system. And at first glance, everything seemed fine, just like Spain. No inflation? I guess we can print even more. Debt is just a number. This money is just free. And I mean, really think about this. 2020 was one of the worst years in the history of the United States economy. Yet, 2020 was one of the best years in the history of the stock market. Now, eventually, things like inflation did peak at around 9% in 2022 and 2023, which was a 40-year high. Housing soared everywhere around the world. Energy and food prices, they also soared, crushing the working class. Yet, everyone that had lots of money in the stock market, or were large real estate investors, they made out really well. And to top things off, on top of the money printing, the United States kept taking out debt, also just like Spain. By January 1st of 2025, the United States debt has surpassed $36 trillion. Interest payments on this debt, just the interest payments, are nearing 20% of all federal tax dollars. In fact, the interest payments on the United States debt this year will be more than the entire military budget of the United States. And the government keeps spending and keeps printing like nothing is wrong. And that begs the question, how does this all end? At this rate, America is heading for a Spanish tier collapse with just some different branding on it. They keep running massive government deficits, assuming debt doesn't matter. They have outsourced most of their key industries instead of producing things at home. They've inflated their economy with excessive money supply growth. They are pricing out the middle class from key investment fields like the stock market and real estate. Wages haven't really increased that much, yet the cost of living has gone up pretty drastically. And yet, the United States thinks it can just keep papering over these problems forever. So the realistic outcomes are inflation will return, forcing more extreme Federal Reserve policies, or the government keeps printing money, destroying the dollar in the process, or the debt spiral will eventually become unmanageable, leading to default or hyperinflation. One way or another, the bill is coming due. And the irony of all of this? The quantity theory of money was literally created to explain why Spain's economy collapsed. The US adopted this theory and followed it for a really long time, then ditched it at the worst possible time. And now, just like Spain, in the 1600s, America is on the express train to economic disaster. And just like Spain, we're all supposed to pretend that this is just fine. Now, it could correct its path by cutting spending, paying down the debt, or stopping the money printer. But almost every administration says it will do that, and yet it never does. Will this time be different? Who knows? Anyways, see you guys next time.